Hello, everyone. My name is Tian, Head of Research at Variant Perception. And today I'm joined by Simon White, Managing Editor at Variant Perception. And we're going to have a discussion around a potential new dawn for commodities. So Simon, the kind of commodity new dawn, the bullish commodity trade, that's been somewhat of a widowmaker trade for the past few years. We've seen a number of people try and call the bottom in things like oil, things like natural gas. But today, it does feel like something's a bit different. Structural and cyclical forces do seem to be coming together, coming out of this recession. Could you take us through what you think are going to be some of the key drivers for the commodity markets as we head into 2021?
Yeah, thanks, Tian. So this is based on a recent report that we put out that we'll release to Real Vision viewers. And it's basically, the title kind of gives it away. It's the next commodity supercycle. And what we've seen basically is an alignment of drivers that have come together. Normally you get one or two things happening and it's kind of makes something quite interesting. But today we've got a very compelling kind of lineup, as you said, structural and cyclical. So, the way I would think about it, we have the overarching kind of theme of the macro drivers. So we're in a very different, what we've called an inflationary regime now. We've basically left the sort of era of monetary policy dominance, and now we have much more activist fiscal policies. And if you look historically, that tends to mean that the underlying inflationary risks have risen. And in that environment, you kind of financial assets are unlikely to perform as well as real assets. But on top of that, we look at, we're always very data driven in Variant Perception. And we have built what we call our capital returns framework. And what that basically looks at is it looks across all the industries, and we try and find industries that are essentially capital scarce. So they've seen essentially money coming out of them for an extended period of time, investment coming out of them. And that leaves them in a situation where they are really unable to respond to a change in demand. So the companies, or the types of companies that kind of float to the top of our screen, even before we get to this sort of macro environment, are a lot of commodity sectors. And that to us is very interesting. We've seen a lot of disinvestment coming out of commodity. We had the last commodity super cycle, the peak was maybe 2011. We're coming towards the end of that. So there's not really a situation where many of these companies could respond properly to a change in demand. And where's that demand change going to come from? Well, there's kind of two things. There's real demand, where there's a recovery essentially in demand coming out of this global recession. It's going to be slow, but it's certainly moving in one direction. And on top of that, we have investor demand as well. The people are investors. The whole investment community is very largely underweight real assets like commodities. And that means when we're in this new inflationary environment, people need to start thinking about hedging inflation risk, and they're worried about the currency that things are denominated in, i.e. the dollar or fiat money in general. Then they're going to have to start looking to alternatives. Real assets and commodities are one of those alternatives.
Okay, so there's a number of points there to unpack. So maybe we can start off with, I think you use the phrase fiscal dominance. What do you mean by fiscal dominance? Like, what kind of regime have we been in, and why are we moving towards this fiscal dominance?
So it's kind of a fancy term, but the term really means fiscal policy dominance, and really it's the norm of things. So you look historically, over the last 100, 200, 300 years of central banking, generally it's the government that essentially has the upper hand in how monetary policy is driven and how it's.
Hi, I'm Raoul Powell. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to realvision.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to realvision.com, it costs you $1. I don't think you can afford to be without it.
100 years of central banking. Generally, it's the government that essentially has the upper hand in how monetary policy is driven and how it's organized. The last 30 to 40 years are really a bit of an anomaly, and especially the last 20, 25 years, where you basically have the situation, the conditions of very kind of low inflation, low and kind of well-behaved inflation, that's allowed governments essentially to allow central banks to have more upside when it comes to organizing policy. So basically, we've been in an environment where what's called monetary dominance, where central banks can set interest rate policy essentially for the needs to keep employment. They have an employment mandate often, and obviously to keep inflation low as well. And that era is kind of coming to an end. And the reason for that is that the drivers that allowed central banks to be able to operate policy as they did are now kind of running out of road. And we're sort of realizing that the more central banks get closer to the zero bound, the harder it is for them to have actually any discernible impact on conditions. Like there's a recent article from Bill Dudley, ex of the Fed, making that exact point. The Fed is coming to the end of what it can conceivably do. Rates are near zero. There's a few things it can do. It can make rates negative. Does that make a big difference, or is it counterproductive? You look at Europe, quite likely it's counterproductive. They can also, buy more debt. They can do more QE. Again, that seems to have the law of diminishing returns when it comes to these sort of policies. And there's really only one angle left, and that's what Bill Dudley said, and it's what a lot of people are saying, a lot of central bankers are saying, is that we've kind of run out of road here. We need some help, and that help comes from the fiscal side. And that's basically what's happening. You're seeing more activist fiscal policies because it's really the only way to to try and stabilize the economy, especially when you hit crises. The great financial crisis, 2007, 2008. The only entity that could really rescue economy from that is the government. And then once they're in that situation, it's very hard for them to get out of that situation. The latest, crisis to befall us, the pandemic, is just another example. There's no entity big enough, strong enough that can basically salvage the economy in such a big crisis situation as the government. So the government is having to step up. But the difference here is that what we took as low risk environment for central banks when they practice things like QE have not led to inflation. And that's lulled people into a false sense of security, because it's very different when a government begins to borrow and spend with impunity, because not only do they create, there's more money created so it can do the spending, it also creates the demand that goes with it. And that potentially, historically speaking, has often led to much higher, and some in extreme cases, hyperinflation.
Okay, so you cited a few examples there, 2007, 8, and talk about how, before this era of central bank independence, Keynesian-led thinking tended to dominate. So I guess what we're actually trying to say here is that this expansionary fiscal policy is likely to become a more permanent state. So compared to, the last 20 years, when fiscal policy is expansionary, they're going to run deficits for many years now, right? It's not like before where you just run it for 1 or 2 years and then you back off and then you go back to letting monetary policy drive. I think what we're seeing is a shift to where fiscal policy is going to be very expansionary for a long time, and then the role of monetary policy is just to help finance that deficit. And there's a number of historical precedents, right? I mean, previously we talked about things like, the Fair Treasury Accord, 1942. But again, it's very similar where like we have the pandemic this year, you have you have World War II, and and the saying is that central banks have a moral obligation to help the economy. So therefore, you should help by buying government debt, keeping interest rates low, allow governments to borrow and spend. And I think that's the kind of setup we have today. And I guess the concern is that we have a repeat of potentially the 1960s into the 1970s, where as this situation persists, inflation expectations become unhinged. And then obviously you get a lot more inflation and then becomes somewhat problematic. So I was wondering if you could dive a little bit into kind of, some potential lessons we would learn from the 60s and 70s, and really how should we think about inflation now? If we are moving to this different world of fiscal dominance, what's going to happen to inflation?
So the 1960s is a great example. I mean, the way we've characterized it is that the inflationary risks are greater now than they've been since the late 1960s. Obviously, the late 1960s in the US, that led into the 1970s, the stagflation, and that was a decade that was kind of pockmarked with very high, often double-digit inflation and very stagnant growth. What's kind of interesting, if you look back at that period, like what kind of what kind of kicked it off. You basically had expansionary fiscal policy, but you also had it at the same time as where the central bank, the Fed, at the time believed that it had more room to ease than it really did. So they were essentially acting in concert with the government. So you had the Nixon administration, who was basically wanting easier policy to probably help with the election in 1972, but obviously to help the economy as well. And you had essentially a pliant central bank that was willing to help the government in that end. And that really sowed the seeds. Now, the situation got a lot worse as the 1970s went on. They had a lot of bad luck. They had, Nixon closed the gold window in 1971. So that was the final link between, fiat money and anything actually solid behind it. Then you had the Arab oil embargo in 1973. The end of the Nixon, wages and price controls came after that. And then at the very end of the decade, you had the Iranian revolution. So all these things were kind of like, I guess you could say, sort of bad luck. But the seeds were sown by essentially fiscal expansion and central bank aiding of that expansion. And the parallels here are kind of interesting as we have fiscal expansion to deal with a crisis. We also have had the most radical change in the federal central bank's monetary policy for a long time. They have now moved to an average inflation targeting regime, which essentially means that if they see any undershoots in inflation, they're more than happy to allow an overshoot in inflation. They've not given any sort of idea about how long they would allow it to overshoot or how long they care about an undershoot. I think that adds to the uncertainty. And also they're trying to target maximum employment too. And what that basically tells us is that they're willing to kind of play with fire, if you like. There's a willingness, just because we haven't seen inflation for such a long period of time, it's, as I say, lull people into false sense of security. And there's a willingness to allow inflation to go a little bit higher. And then a belief that it's very easy for the central bank that once they see inflation, say it's at 3.5%, like, oh, you know what, we'll put the brakes on now and everything will go back to normal. Our fundamental argument is that that won't happen because the underlying risks to inflation have changed. And in this new environment, we've characterized it as the lake regime and the ocean regime. So we came from the lake regime where, situation is very calm. And if you had sort of rises in inflation in the lake regime, they're unlikely to turn into anything particularly nasty. Central banks could just tweak interest rates a little bit higher and we could all go back to sleep. But in the ocean regime, which is basically where we see ourselves now, conditions can very quickly become much more turbulent. And in the ocean regime, a garden variety rise in inflation, say from disruption to a supply chain or cost push, demand pull, all the usual reasons that you might get a slight move higher in inflation. In the ocean regime, they can suddenly move, turn into much larger rise in inflation that are disorderly. And the takeaway here, as far as we're concerned as investors and people that advise investors, is what does that mean for your portfolio? In the same way that, lake-going vessels are not suitable for ocean-going travel, how should you be thinking about your portfolio to make it more ocean-ready?
I see. So there's a few interesting points you raised there. You mentioned the Fed's shift in monetary policy regime, but that also made me think of all the discussions we were having before the crisis hit about MMT, modern monetary theory, and so forth. And it seems like a lot of the intellectual justification that will be needed to create an inflationary macro environment has been laid already, right? On the one hand, we're saying we should just spend as much as we can until there's inflation. And now you have the central bank saying, yes, we agree with that. Let's just keep going until we get inflation. Let's all do it together. And at the same time, another quite obviously extreme shift in monetary policy regime this year is the Fed is going out, buying corporate debt, buying high yield debt, causing the deterioration of their own balance sheets. And as you mentioned, right, since Nixon, took us off the gold standard, the Fed's balance sheets continue to deteriorate, and in turn, obviously, the value of the dollar it's backing is going to become less and less credible over time. So it does seem like a lot of these things are coming together to, take us into this ocean regime, as you say. But obviously, when I think about the ocean regime, I don't think it necessarily means we're going to 5-10% inflation tomorrow, right? Like even in the 70s, these things take time. Typically, you need people to stop doubting, what inflation actually is, to suspect their cost of living is going up much higher than they expect. Then when it comes to negotiating wages and so forth, they demand, CPI plus 5 or whatever it is. And then you get these wage price spirals. and you really kind of lose control. So I guess for investors today, this is more of a, later on in the cycle, as we use up the excess slack in the economy, that's more worrying. But I guess today it's actually just literally about pricing in the risk of inflation, i.e. the risk premium for inflation probably needs to start going up. When we still look at things like the US Treasury curve, right, term premium still incredibly negative. And, obviously we know nominal rates are hitting zero. It just seems like, investors are really setting themselves up to lock in some very negative real returns. And to that end, obviously we've seen, the start of the moves in things like gold, obviously commodities starting to do well. But really it's quite hard to think about what are the ways to actually hedge inflation. So, I wonder if any thoughts on what are the different ways investors can do it. Gold's an obvious example, but what about others? What about actually going and trading inflation swaps? What about Bitcoin and the like? What do you think?
So yeah, I mean, we always end up, what's the best way to do this? And I'd tie back to one point you mentioned, exactly. Just because we've moved into this new regime, it doesn't mean that all of a sudden we're going to hit high inflation. We, along with all our sort of longer term indicators, we look at a lot of shorter term, more cyclical indicators, and they're saying right now that over the next year at least, you should be expecting more disinflation. And that's kind of what you'd expect to see, coming out of a recession. Inflation is a lagging indicator. It tends to peak when the recession is happening, and we've kind of probably already seen that, and then it starts to taper off. But the longer term environment has changed, and you could be in the ocean for a long time and have perfectly placid weather, but when it changes, it can change very badly. So in that environment, you want to prepare. And as you say, how do you prepare? So I think there's two things. There's two ways we're looking at it. So there's a shift towards making your portfolio more inflation resistant today, and that involves things like, as you said, that involves adding more exposure to things like gold or inflation swaps or other alternatives like Bitcoin, and maybe we can talk about these things in a bit more detail, later on. But the key is to start thinking about doing it today. And obviously the main thing, the main thing we think that people would want exposure to in this inflationary environment is commodities. And again, you go back to the 1970s, that's the most sort of recent example of like a, Western country experiencing sort of like very high inflation, double-digit inflation. And if you look by the asset classes, you look at commodities, equities, etc., the only asset class that delivered a positive real return, and that's obviously the key here, real return, in the 1970s was commodities. Every other major asset class delivered a negative real return. And we've become so used to, I think, really conflating real and nominal returns. In a low inflation environment, it doesn't really make much difference. But in an environment where inflation could potentially move much higher, you really need to start paying attention to your real returns. So commodities were one of the best performing asset classes, or the best performing asset classes in a real return basis in the 70s. Equities generally were a kind of a shunned asset. Equities essentially, they've got the return on equity. With a bond, you can negotiate the coupon. There's a maturity with a bond, whereas equities have infinite maturity. And equities essentially in this high inflationary, higher rate environment started to become a shunned asset. So overall, equities didn't do very well at all on a real or a nominal basis. But within equities, certain sectors did very well. You look at energy stocks, industrial stocks, material stocks. These sectors performed the best in the 1970s. So, you want to start looking to orientating your portfolio towards essentially real assets, right? Or companies or firms that basically have access, or they're very close to real assets, so they're going to benefit from real assets upside. And why you want to start, another reason why you want to start doing that now is because you won't be the first person to do this. As it becomes apparent that we're in a new regime, in this ocean regime, and inflation risks have risen, more people are going to have to start thinking about reallocating more to real assets like commodities. And obviously, and this is the next part which I want to throw back at you, is that could happen at any point, right? That this particular setup in some ways could happen at any point. We don't know when inflation is going to come, but we think it's in this cycle. But why particularly now, given some of the things we've looked at, do you think is a good time to start looking at allocating to some of these commodity sectors and some of these commodity industries?
Yeah, so I think what makes commodities as a sector stand out to me is Typically the supply response tends to take a while. If you're going to build a new mine or drill a new well, these are typically timescales measured in the order of years, right? A new mine or conventional wells could be 3 to 5 years. Okay, maybe some shale can be a bit quicker, 1 or 2 years, something like that. But typically there's this pattern where supply responses are very delayed, and often producers tend to wait as well to really make sure there's an upturn before they action new projects. And what that lends itself to is prolonged periods of mismatches between demand and supply. So this is something quite unique to the commodity sector, and obviously for a lot of capital intensive sectors, this is a property that inherently means it has kind of these boom bust cycles. And what's interesting for commodities, obviously we've had quite a long kind of bust. It's been pretty capital scarce. Most investors have been fleeing the sector. There's not been a lot of capex, not been a lot of investment going in. So a lot of the preconditions that are needed to ensure that supply remains tight and remains tight for a long time is in place. So now if you just get a pickup in demand just for a natural economic recovery, and then eventually, from investors moving into the sector because of this, massive underweight or structurally the fact that very few investors have commodity positions, I think those things are going to come together to create a quite potentially explosive move in prices. It's very interesting from a portfolio construction point of view that if you look at the history of commodity price returns, typically when commodities have high volatility, it tends to be to the upside, which actually gives it a quite nice property because, typically for things like equities and so forth, usually the higher volatility phases are when they're crashing, right? So the volatility smile, is priced to be more to the left. So I think there's a few things that naturally make commodities a bit more suited as we move away from fixed income, as we move, as we hit the zero bound for commodities to take on that role. It's obviously had a longer track record, it's been more proven, and a lot of the demand supply dynamics actually a bit easier to kind of judge as well. Now, obviously for things like gold, where it's not really consumed for anything, actually it's a bit harder to judge because obviously whatever supply there is, but it's not really consumed, right? So the supply tends to grow over time. And arguably for Bitcoin, obviously supply doesn't really move, but it's not really consumed either. But the cute thing about a lot of the commodities, as you mentioned, right, energy, metals and mining, is that over time, obviously they have to get consumed as well. So there's obviously natural rate of decline on the supply side, and they naturally have to be replaced. And so, when these sectors lose access to capital, you get very extreme tightening in the supply side. And then obviously when the demand picks up, you get the kind of explosive moves higher. So that's kind of basically what we're seeing right now. So, and the way I think we've really kind of tried to focus in on this is using the capital returns framework that you kind of mentioned earlier as well. So here, if viewers are interested, I think the best thing to read is a collection of reports by Marathon Asset Management in a book called Capital Returns, which was edited and put together by Ed Chancellor. And I think that was really the book that originally inspired us to kind of really think about how to build a quantitative framework around capital cycles and to really, drill down into this. And so, obviously at Variant Perception, this is what we've done. We typically look at things like, capex and R&D relative to the asset base, things like depreciation, amortization relative to asset base, what's the return on capital, right? So typically in capital scarce sectors, there's not a lot of capex going in, but obviously a lot of the asset base is being worn down, and yet, returns on capital is actually leveling out and starting to pick up. And this is kind of what we've been seeing in things like energy and things like metals and mining. And so those are kind of probably the areas we really want to be drilling down into and trying to actually think about what are the best parts to invest in.
And then if, looking back historically, this capital returns framework, I think it's worth emphasizing, if people spend so much time focusing on demand, analysts will be trying to focus, how many flights people are going to take, how many X, Y, and Z people are going to use, widgets, whatever. And it's very difficult, obviously, to try and figure out what's happening with demand, whereas actually trying to gauge what's going to happen to supply is actually much easier. And so in an environment where you see, say, capital coming out of a particular industry over a persistent period of time, or the other way around, if you're seeing lots of capital coming in, it really gives you a good sign that that industry is going to either underperform or outperform. You look at, for instance, shipping in 2007. Obviously the lag times there between, putting a ship order in and the ship getting built, it's several years. The housing market, Spain, US, Ireland, make your pick, around 2006, same sort of thing. You had a huge glut supply coming on just at the point where demand, was collapsing. TMT boom in the late 90s, all these things, the great examples of where you've seen a capital cycle either peaking or troughing. And where we are today with the commodity cycle last peaked in 2011. So right when you had a lot of these projects coming on board, this was like coming into the shale and the other stuff that later in the decade, but you had a lot of these projects coming on board at the worst possible time. Because at that point in time, capital was flooding in and a lot of capital was being misallocated to bad projects. And here we're just at the other end of that cycle. I think what's interesting to emphasize, though, is that, we didn't just run this on just commodity sectors, this capital returns analysis just on the commodity sectors. We've done it for the whole world and for all sectors. And the sectors that appeared at the top are commodity sectors. So they're not just within commodities. We're looking at, for instance, gold and silver and oil and gas. This is among sectors across the whole world. So I think, maybe it's worth emphasizing that even without the inflationary backdrop, which I think is huge in terms of the inflationary risks changing, the commodity sector is still primed to outperform over, say, the next, 1, 2, or 3 years.
Yeah, and I think it's worth also just repeating that the capital cycle is actually quite an intuitive idea, right? If you have lots of money chasing limited opportunities to make profit, then obviously over time it's going to destroy profit, right? If this industry looks very sexy right now and all the money goes in the end, okay, a lot of infrastructure might get built, a lot of nice things might come out of it, but the investors didn't make any money. What you mentioned, 2000 .com boom, building out the fiber network and things like that, right? Typically, if you have too much money chasing what are actually brilliant ideas, if there's just too much money there, then nobody makes any money. And obviously, conversely, if an industry is extremely hated, there's no money flowing in, then by definition, the kind of marginal return needed to attract investors to go in will be higher, and there's obviously a lot less competition. So then the cycle becomes the money flows into the hated industry, it makes outsized profits. Over time, that attracts more investors into the sector. And then obviously, the new entrants compete away the profits until eventually, a lot of the weaker guys can't make a profit and they have to leave. And then you kind of go back, the cycle starts again, right? And the survivors do well. So there's all these signs now coming together for things like oil and gas, gold mining you mentioned, right? I mean, copper is another one we've talked about. So maybe this is something we can dig into a little bit more, because so when you talk to people about investing in commodities, people typically wonder, should I do it directly? Should I just invest by ETF with just a commodity fund? Or should I be looking at just buying ETF in the sectors, or should we be looking to pick stocks and so forth? So I think in our, at least for me, I think the key is to actually emphasize stock selection within commodity producers. Typically, commodities as a sector has not lent itself well to just buy and hold long the commodity itself, just because of these boom bust cycles that happen. And because of the fact that the volatility tends to be very much to the upside, you actually need an actively managed strategy to be able to capitalize. So basically, when it's on the way up, you either need to rebalance or sell and then rotate to kind of maintain. And obviously, we've done analysis showing, if you have a rebalancing long commodity strategy over time, it obviously significantly outperforms just the buy and hold, just if you just go off commodity futures contracts. So there needs to be an element of actively managing the cycle to really make the most out of it. And so in many ways, it's going to be hard for investors to do that themselves. So you want to probably outsource it to actively managed fund manager, or actually buying the equities of companies. If those companies are well managed, is almost another way to outsource the active management, right? Then it's up to the commodity producers to be able to manage their expenses well, and then as prices go up, to try and monetize or generate cash flow. So I think for us, with this underlying understanding that in a boom bust cycle, active management is important, and you can't just sit in the cycle for the whole period. Picking which parts of the industry and picking the stocks really becomes very, very important.
Well, I think that's a really actually critical point. and it's another point we touched upon, in our presentation, is that in this new kind of regime that we're talking about, like the whole investment world is almost going to be turned upside down. All the things that people took for granted in the last 20 or 30 years, are probably going to be turned on their head to some extent. Like people have just got used to the fact that stocks and bonds are negatively correlated. But you look historically that when, real rates tend to rise, basically we're in higher inflationary environments anyway, the stock bond correlation tends to rise. And if you look at like the 3-year rolling stock bond correlation, it's gradually moving higher. And that basically puts a huge amount of investment kind of strategies at risk. Essentially you're two things here. First of all, you've got no real assets exposure. You've got two financial assets, stocks and bonds. And they're now not negatively correlated, so they're not giving you any diversification benefits. They're in fact reinforcing one another. So still that sort of mindset, I think has to fundamentally change. I think people are already, if you look at gold, where gold is today, it feels like where gold is today is where other real assets and commodities might be in a year, 2 years, 3 years time, because a lot of people who wouldn't touch gold even a few years ago are now dipping their toe in. A lot of people, very serious investors, are now beginning to, I think, feel that the environment is changing and inflation risks are rising. And in that environment, in some ways, the purest inflation hedge and the most obvious one is gold. So you're seeing a lot of people that never would have been involved in gold are involved in gold. The problem with that, of course, is that when you have lots of people in a relatively small market, it means gold is now suddenly trading sometimes like a risk asset. Because people, market goes down, people still maybe, because it's a very liquid thing, they get rid of their gold, so gold goes down with it. I don't think that should put people off when it comes to gold, but I think it does mean that the environment for real assets in general, if we're right, that people are going to have to allocate to more real assets, will make their investment more difficult, which ties back to your point, this is not something that you can necessarily just buy and hold. So, we used our capital returns framework to basically come up with industries that we see as the most capital scarce. A lot of these industries are, commodity based, and a lot of them are actually oil and gas sectors. So looking at the oil and gas sector much more closely. I mean, obviously everyone knows about the shale boom and bust that we've had. Obviously, that has a lot of geopolitical implications as well as implications for investors. But why do you think now is a good time for people to be looking at oil and gas, not just from a sort of macro perspective, but looking at the industry a bit more closely?
Yeah, so I think it's about the lack of access to capital for the sector that's forcing noticeable changes in behavior. So in the original 2014 bust, even though obviously share prices initially crashed, oil prices initially crashed, a lot of companies were able to survive, raise more financing, and actually keep drilling, keep trying to grow production. And that's what's really different this time around. On the back of this crash, access to capital is really drying up. If you just look at transcripts of what companies are saying, if you look at just surveys of CEOs of all these E&P companies, there's a lot more emphasis now on balance sheet, on reducing debt, on trying to raise financing, and simply moving towards maintaining production and actually thinking about cash flows. And I think that's something that's really been a big shift this time around, which actually should naturally restrain the actual supply response, even as oil prices go up this time. And as we talked about before, to get kind of these major sustained periods of demand-supply mismatches, you really need to have supply not be very responsive. And so 6 years since the bust, what we've seen is obviously major cuts to capex everywhere within the sector. Research budgets are obviously down. And now the lack of access to capital means that there won't be as much of a supply response, as the economy normalizes. In terms of demand for oil, yes, obviously 10 years, 20 years out, clearly the world is moving away. But in terms of just this year, next year, these transitions take time, right? The demand for oil can still get back up to roughly where it was pre-COVID, right? Like, are people, obviously once the virus is more contained, or there's a vaccine, or there's herd immunity, people are still going to go on holiday in the future, right? Like, it's not unreasonable to think that demand for energy is going up. Yes, the mix towards renewables will change, but even for the kind of oil and gas fossil fuel bits, it still has a reason to exist, and it's going to And so, and there's still definitely going to be room in it for kind of another last cycle up. So, the key here is that the supply response has been real in the sector, and it's going to be limited on the way out. And especially now that you're going to have this talk about ESG, Green New Deal, it's going to massively deter new projects, new capex. So you got this actually somewhat of a sweet spot setup where there's just not going to be much of a supply response on the way up at all compared to kind of usual. And that might actually lead to a more prolonged period of elevated prices before the kind of next bust cycle comes through. So yeah, I would say that that's probably the number one thing to focus on. Now, having said that, clearly it's important to differentiate between the different parts of the industry and how it works, right? Very broadly speaking, you got, EMP, so exploration production guys, right, who are obviously trying to drill for this, look for this in the ground or in the sea, right, and try and drill for it, and right through to, the pipelines or the transportation infrastructure in the middle, right through to the downstream guys, who are doing the refining or doing the marketing around it. And then you have obviously the kind of oil field services or the servicing equipment providers, right? So the guys that are providing the drills, providing equipment, or kind of helping with production. So those are the various parts. And what's very interesting is that actually oil field services, the Schlumberger, Halliburton, and so forth, they're not actually flagged as super capital scarce right now, but every other part of the sector is. So even within the sector, there's a bit of differentiation. And in particular, what's really being flagged as capital scarce is more on the EMP and midstream side. So those are the areas that are truly being left for dead by investors. Absolutely nobody's interested. Obviously we know things like the MLP structure is basically no longer viable at current kind of at prevailing market prices. So that sector has basically been completely abandoned by investors. And yet, if you're willing to go do the work and look through some of these midstream assets, you'll often find you're picking up like a toll road, infrastructure type of asset, right? Like in this environment, if I would say to you, hey, do you want to buy a railway? They're trading on very high multiples. People think of them as, critical infrastructure, monopoly, right? And nobody's going to, it's not going to be replaced, and they're just collecting their tolls, but they're valued very highly. Yet if you go to the, oil and gas space and you look at the best pipelines, right? Say, from the Gulf of Mexico, that's absolutely necessary. Nobody's going to build a second one. They're trading, at 40% discount to what, book value or something like that, or even lower, right? So there's quite a big kind of valuation discount on quality assets just because they have the label of oil and gas on it. And I think these are the kind of things that actually make it very, very interesting to kind of dig around.
That would be a risk that I would bring up, because it feels that, there's certain industries that have just been left behind, as you said, capital starved, because they're just not ESG compliant. A lot of ESG investing, it used to be they try and think about what is ESG and then see if it ticks a lot of boxes. But some ESG investing, because it's easier, you just get rid of whole sectors that you count as not ESG. So for instance, coal. We discussed coal in the report as well, probably the least ESG compliant sector you can think of. Obviously that makes it difficult, but what would be your response to that sort of pushback then? If people were saying, hang on a minute, what's the point of me investing in these industries? Because if no one else can, then nothing's going to happen.
I think this goes back a little bit to kind of value investing, or what intrinsic value is, right? So obviously a lot of the ESG things about whether these things can re-rate. Are there somebody else to buy off me at a higher price, right? Which is obviously a critical part of a lot of investment thesis, right? You need the market to be able to re-rate higher for you to kind of monetize your investment in a lot of cases. However, if the ESG headwinds are so large, say in coal, right, and you get assets that are still cash flow generative, okay, that can still churn out lots of cash, starting to trade on 1x or 2x EBITDA, right? And where the debt is starting to trade at 60 cents on the dollar, but the debt is covered by 1 year of earnings. These are when you get into extremely cheap valuations that right, where you're like, at some point, I'm not relying on the re-rating for me to get my money back, right? I'm still viewing businesses, I'm viewing shares as businesses. I still see the cash flow they spit out, and then all I'm going to do is I just need that cash flow to be made, and then I'm made whole, and everything else is kind of upside. And coal is a very interesting one, because obviously it's understandable, and if people have a value judgment they want to make, they don't want to invest in, it's perfectly understandable. But arguably that's what's creating the kind of opportunities in the sector. Globally, coal still accounts for about 35% of electricity generation. In a lot of emerging markets, it's 60 to 70%. And obviously in the Western world, US, Europe, it's more 10 to 15, right? And so even then, the transition is obviously being sped up. Policy will try and drive the acceleration away. But, if you just need 1 or 2 years to get your money back, it's kind of looking very attractive. And obviously, if you go to emerging markets, there's obviously a much longer runway for potentially these companies. And because it's so hated, you look at some of these EM companies, like their return on equities are averaging 30, 40, 50% over a cycle. Say if 2016 to now is a cycle, which is just, if you just remove the name and show people these numbers, people would definitely want to know, right? But obviously because you slap that label on and it's just gone. So I think it's, these are things where there's a lot of intrinsic values there that, you can view as almost, this is more classic cigar butt type investing, right? There's like a decent puff left in the cigar butt. Do you want to kind of invest there or not? And oil and gas probably not quite the cigar butt to the same extent, but clearly a similar kind of setup. If you look at energy's share of the S&P, it's like a 2%, right? We're at like all-time lows here. And what's very interesting is that historically recessions often mark major changes in market leadership or trend reversals. And energy's kind of weighting in the S&P is basically seeing quite a big turn after the last 4 or 5 recessions in the US. So, I think it's pretty, it's obviously a very contrarian setup, but at some point the intrinsic value gets so compelling that it becomes worth looking at.
I think, as you say, it's like there's no such thing as something being absolutely cheap or expensive. It's always relative to expectations. And that's kind of what applies in some of these industries we've been looking at. I think another point worth mentioning as well is that with all this money being thrown at green projects now, so you mentioned the EU Green Deal, that the US, we may have a situation where there's a lot more money thrown at green deals there as well. And that makes it essentially easier for some of these companies to essentially borrow, attractive financing, to borrow to make their businesses more environmentally friendly, to more ESG compliant. So that's certainly something we begin to see. I know that certainly some gold miners have had access to various forms of green funding, often, as I say, enhanced conditions because they're kind of government backed, to make them more ESG compliant and more green. So that's another angle that could obviously help with some of these commodity companies in this cycle.
The talk is obviously net zero by 2050. That's kind of the more aggressive, right, targets that people are talking about. And obviously, in order to hit those, there does need to be quite a big shift in the composition of kind of energy supply, right? A lot more towards renewables and so forth. But obviously, the delta versus that to what is kind of an average expected pace of transition versus, i.e., business as usual, that's still quite a big delta. So I think it's just more what we're seeing is that we're priced for kind of very extreme, kind of, probably even more aggressive than that kind of energy transition kind of path. And the reality is that these things are typically quite messy. So, I think clearly it's not going to be for everyone, and arguably just slapping an ESG label on an oil and gas company will probably not satisfy a lot of potential investors. But at the end of the day, I think it's about if you're investing and you're trying to generate return and it's your primary focus, then the valuation can become quite compelling at some point. But obviously, if you're driven by more value-based approach, then it's understandable why it might not fit for everyone. But having said that, obviously there's only certain parts of the commodity market that would not be ESG compliant, right? There's others like copper. There's commodities linked to the battery revolution, right? I mean, lithium, nickel, some of these other ones, or the rare earth metals, where again there's going to be a similar dynamic potentially at play. Obviously, what we found is that copper is potentially, as an industry, actually quite capital scarce versus some of the other ones. Obviously, the sexier you are, the more linked to technology, the more capital has generally been available. Copper has been that kind of funny no man's land in the middle where it is going to be a beneficiary, but it's probably not seeing as much investor interest as probably compared to the kind of really, green kind of technology stuff. So yeah, I think if investors don't like it, something like copper has still got a very nice setup, as we mentioned, right? again, and even why countries like China, there's potentially a China wave behind it, where China consumes, half the world's copper. They only mine about 5%, and as we go into this arms race in the future about US versus China, who's gonna get there first in terms of transforming their economy, coming up with new green technologies, electrification, that everybody's going to be demanding more of these commodities, right? This is like a potential big arms race that then gets replicated in urbanization projects across the world. So could be a very similar kind of big upshift in demand that persists for decades. And as you say, if ultimately government policy starts to back it, and in particular, if governments puts funding available towards research in the area to really kind of ensure the technology starts being adopted at a faster rate and more efficiently, then there is potential for kind of a really big super cycle in the kind of in some of these materials like copper that can benefit from both a capital scarcity inflation point of view, but also from the green technology point of view. And so Simon, I guess where do you think gold and silver would fit in that spectrum of benefiting from inflation versus ESG?
Well, I think they've got their own ESG problems. Obviously, gold mining, silver mining, they do environmental damage. They have problems with their workers in certain, poorer countries. But again, it sounds like they're trying to move down the route of becoming more ESG compliant and getting funding to do so. And some of the mining companies are more ahead of the curve, like Newmont, than other ones. But everyone kind of gets the message now, and they're heading in that direction. And it's as we've said, it's about your price is about versus expectations. So as expectations improve, you're probably still getting a decent price for a lot of gold miners right now. We've looked at some gold miners. I mean, with gold mining, it's the old Mark Twain quote. A gold mine is just it's a hole in the ground with a liar at the top, and often it's about trying to avoid the most egregious kind of gold mining companies. The previous cycle, I think, saw a lot of huge overspend. Their margins were very poor. They seem to have tightened their belt now significantly. They're a lot better run. There's been a lot of consolidation in the sector as well. So that's, a lot of the companies you're buying now are better run, better managed, better margins. And on top of that, like the other sectors we've been discussing, there's been a huge amount of capital has come out the gold mining sector. The result, the annual production peaked about a year or two ago and it's basically plateauing, and now it's starting to come off more steeply, partly because of obviously the pandemic and restrictions on production. But that certainly looks like it's peaked. Exploration budgets have been rock bottom. So there's been no new major gold discoveries for 2 or 3 years. There's always seems to be rumors of some, but I haven't seen any sort of confirmed lately. So it's ticking all those boxes. And as I say, if you just avoid the worst ones, and what we've done in our work is tried to use a screening methodology to find what we consider to be the worst gold miners, focus on the ones that are better quality. And they should do very well. They're very cheap to the price of gold and have been for quite a while. So you're taking on extra risk to the gold price, but you're also potentially got a lot of extra return. So I think 100%, you want to have 100%. You want to have gold, maybe a little bit silver as part of your real asset allocation. You want to have things like gold miners, obviously the other industries we've discussed as well. And then I think as well, what's getting obviously more and more interesting is things like Bitcoin. I mean, Bitcoin has been outperforming gold lately. The amount of money into sort of standard Bitcoin assets. So you've got there's a well-known ETF. That's went from had 3 billion of assets back in May. It's now over 6 billion. And obviously the overall Bitcoin market is massive now. And when you hear like serious investors, people like Paul Tudor Jones came out earlier this year. He thinks it's one of the best inflation hedges out there. Top of that, of course, is not just a hedge. He thinks it's going to be something that's going to perform extremely well. So I think again, you need to be looking at having an allocation to adding things like Bitcoin to that as well, because I think it's something that's very seriously worth considering.
Okay, so Simon, I think today we've kind of had a whirlwind tour through the commodity landscape, right? We talked about inflation, fiscal dominance, supply demand mismatches, oil and gas, copper, gold, Bitcoin, coal. Should we try and summarize now a bit? What for kind of listeners and viewers, What do you think is kind of the kind of key takeaway from today?
I put it very succinctly. The best trades are when you get a number of disparate factors lining up. They're the most compelling ideas. They don't come up that often, but when they do, you've kind of got to seize them with both hands. Today, I'd say you've got four different things. You've got the macro, the micro, you've got price, you've got positioning. You've got the macro, this background of inflationary environment is going to become very supportive for inflationary conditions, probably the most riskiest inflation conditions since the 1960s. You have the micro, you have some of the most capital-starved industries in the world, or commodity industries. You have the price, you have basically real assets, specifically commodities, at a 50-year low to financial assets. And you have the positioning. You have an investment community that is extremely underweight real assets. And when the situation changes and the realization that the risks have changed, this is going to ultimately create a bit of a stampede towards reallocating more towards real assets and things like commodities. So as I say, when you have all the things lining up like that, it becomes an extremely compelling idea and one that's sort of difficult to avoid.
Great. That's a wonderful summary. Thank you, Simon.
Thank you.
I hope you enjoyed this special episode of The Interview, the premier business and finance series in the world. However, this is just the tip of the iceberg. For more in-depth content and expert analysis, visit the membership link in the description to unlock a week's access for only $1. This dollar can change your life.